Last video, we talked about how your bank stocks and your private credit exposure might be the same risk wearing different clothes. This one is actually about what's sitting inside those private credit funds, because the AI story here is honestly more complicated than a lot of people realize. These funds made a lot of loans to software companies over the last several years. At the time, it sounded logical. Recurring subscription revenues, predictable cash flows, relatively safe bet. The problem is that AI is now threatening those exact revenue streams. And when a software borrower starts struggling, a lot of these loans are structured as payment in kind, meaning that the borrower can delay paying interest in cash. And obviously, that deferred interest doesn't disappear, it builds up. Software exposure in some of these funds runs as high as 40%. These same funds are now financing the data centers doing the disrupting. Blue Owl, Apollo, Blackstone, BlackRock, they're all in on the data center deals. The data center lending structures are often secured against hard assets, which does give it a different risk profile than most software loans. But it's still a massive concentration of capital chasing the same thematic bet. So you've got the same pool of capital simultaneously exposed to AI disruption and betting on AI buildout. Whether that's a problem for your portfolio or not specifically depends on which fund you're in, what it was buying, when it was raised, and how much of that book is sitting in software versus infrastructure. As far as I know, most people haven't been told those numbers, which is why the 3 questions worth asking are pretty simple. What's the software exposure in my specific fund? Who's managing it? And am I spread out across different vintages or concentrated into one? Those 3 things will tell you more than the label ever will. And honestly, if you're a retail investor who was sold alternatives as a diversification play without a deep conversation about what's actually inside them, then that's worth revisiting. These aren't instruments most retail investors should be in to begin with. The risk profile, the opacity, the liquid constraints, that's just not a match for most portfolios. Anyways, if you found this helpful or you found this interesting, like and follow so you don't miss the next one.